Welcome to today's class on banking, in the introduction to banking. And last week we spoke rather a lot about the characteristics of the German banking sector. And today we want to dig a little bit deeper in the theory of banking and, so to speak, the financial intermediation theory, or just financial intermediation. Why? Because we want to understand why banks exist. Now, in any science, we want not only to explain the behavior and certain phenomena, but we also want to explain why certain phenomena exist and why, in this particular case, banks exist. Because if you think about this in more, with more open mind, you would realize that it is not a given that banks exist. First of all, you can find many countries, usually developing countries, one has to say, you can find many countries in which banks have not existed for such a long time, or in some cases banks still don't exist. And it seems that banking systems and banks in general are a phenomenon of developed countries. And we all would agree that banks are an essential ingredient in a financial market of any developed country. But if this is the case, if this is the empirical stylized fact that banks just exist, we still need to think about the reasons why banks can do something better than other financial institutions or some other companies, and what the benefits are that banks bring into the economy. So this is why we have to think more about the existence of banks. And then, of course, if we know why banks exist, we can think a little bit more about which functions banks should fulfill and why maybe in the future we will see banks vanish again, just as, for example, fintech companies and new types of financial intermediaries pop up and enter the economic system. And the way we are doing this is we need to think first about financial contracts, because if we want to come up with a theory of banking and a theory of financial intermediation, we have to think about what type of business banks offer. And in this case, it's very general. It's a financial contract. So we'll start out with financial contracts and then discuss the reasons and the explanations you can give for the existence of banks. And later on, we'll focus more on the financial services banks offer and what good comes out of these financial services. By the way, if you're interested in this topic, we are offering several classes on financial intermediation. Some of them are at the master's level. They are offered by my colleague Uwe Vollmer in our economics department. So if you're more interested about this type of looking at banks and looking at financial intermediaries, then you're more than welcome to attend the economics classes by Professor Vollmer. So let's start with financial markets. Now, why do banks exist? We'll start out, just as in any theory in economics really, we'll start out with perfect markets. So everything's perfect. That is, we don't have any transaction costs. We have perfect information. That is, no information asymmetries and full information with all economic agents. And we know that in banking we do have basically two main groups of persons, and in economic agents actually, that is depositors and investors. We have depositors who finance the bank and investors, and we have the bank who then translate this money and redirect it to borrowers. And we have depositors, investors, and they could channel their savings efficiently to investment projects by themselves. So in a perfect market, there shouldn't be any reason why banks exist. Why? Imagine you are actually, probably most of you, you are depositors and you are investors in the bank. You are giving money to your bank and you expect the bank to pay you, well, currently probably 0.1% interest on your deposits with your savings account. And you are an investor in the bank. Now the bank looks for other customers who need a loan. And then the bank channels your savings to those borrowers by giving out loans. If you have no transaction costs, if you have information symmetry, if you have perfect information, why should you give the money, why should you give your capital to the bank just to funnel it to other borrowers? You could simply maybe go to the internet, look for someone who is interested in taking up a loan, and then channel your savings directly and more efficiently to the investment projects by borrowers. So banks would not exist. However, first of all, we have a neoclassical approach that is simply arguing that transaction costs do exist. We have fixed costs of financial contracts, we have project monitoring, etc. And in this neoclassical approach, we would simply argue that banks exist because we do have transaction costs, and it's cheaper for investors to do this via a bank and not look for investment projects themselves. Second, banks provide certain services that are not available to depositors per se, for example, risk and maturity transformation or broker services. And third, this is the information economics approach, information is not equally distributed. And because information is not equally, symmetrically distributed between those depositors and investors in the bank and the borrowers, there seems to be a reason why the bank can offer a better type of service, some kind of intermediation between those investors and depositors and the project investment borrowers, such that banks should exist and banks make this process more efficient. And we'll concentrate on this information economics approach really, because transaction costs, that's rather simple, and it's also tricky on its own kind. Now we'll start with asymmetric information. You probably all know about asymmetric information, and it is present when one economic agent or a party of a transaction, of a contract, possesses more information than the other party. So if the better informed party can take advantage of its knowledge, it may lead to various difficulties in negotiations or even prevent a transaction contract in the first place. That is, if you do know from the very start that your contract partner will not stick to the contract. If you know you're being defrauded, then you wouldn't enter the contract in the first place. And then eliminating problems associated with asymmetric information causes costs. You need to come up with a very clever financial contract. You need to evaluate the project. You need to monitor an investment project. And these all are so-called agency costs, because you need to solve the problem of asymmetric information, because most of the time this is a principal agent problem. Someone knows more than the other one. We call these costs agency costs. And these agency costs, they are equal to the difference between what we call the first best solution at symmetric information and the second best solution, that is the best solution with asymmetric information. And this is what you need to keep in mind. So we have to compare two situations. First, it's with symmetric information. This is the first best, simply meaning that this is the best you can do in any constellation, in any situation. If everyone has perfect symmetric information, then this is the first best solution. And with asymmetric info, then the optimal solution is the second best. Okay. And if we compare these two situations based on any kind of metric, could be a monetary metric, could be cash, could be utility, then this is the amount of agency costs you have, because you need to eliminate these costs in order to get us to a situation where you would have symmetric information. I'm asked if I could give an example for asymmetric information. Very simple. The basic example I also give in the introduction to business. Principal agent situation. You are a principal, you are a shareholder, and you're hiring a manager. and the manager is then your agent, the manager has a different incentive as you as a shareholder. You are interested in shareholder maximization. The manager is interested in an optimal wage, in a higher salary. And if the salary is fixed, he or she will not work too much because he or she is getting a fixed salary. A second example, in case of banking. Now, imagine you are a depositor. You want to invest your money in an investment project at with certain risk and a certain return. Then you would need to look for investment projects in which you can invest. Problem is that you need to look for a project. You need to evaluate this. You need to know, is this a good investment project? You need to monitor it. And then you need to come up with a financial contract with your investment partner. This is all these costs and all the things you need to do. These are all due to the fact that you have asymmetric information. If I were to tell you, I have a great investment opportunity. I want to open a company that offers sneakers, that produces sneakers. You would need to ask me what type of sneakers, what is your business model, what is your strategy, do you have enough financing, what is your overall market assessment, what is your plan? And this is the asymmetric information, really, because you do not really know what you are investing into. I, as the company who needs financing, I know all about my business plan. I know all about my business model. Best example, maybe currently Wirecard. Yeah, obviously, huge asymmetric information. The company had serious problems, was not worth the money you thought it was worth. And investors had asymmetric information. They knew less about the company than obviously managers did. So this is asymmetric information. And asymmetric information and financial contracts that are designed to reduce asymmetric information, or at least reduce the problems associated with asymmetric information, these play a central role in banking theory and in financial intermediation. So, financial contracts incorporation. Now, when we give out a loan, we have service and compensation. So service is you give out lending, you have to pay interest, and compensation, that for example is loan repayment or profit participation, they do not take place at the same time. So the design of financial contracts depends on the certainty of compensation and the information distribution and the risk tolerance of lenders. So we need to know what type of risk are you willing to accept, what is the information distribution, is it symmetric, is it asymmetric, and we need to know about the certainty of repayment, the certainty of compensation. Is the loan, is there a certainty that the loan will be repaid, or is it that it could be repaid, or that our investment project could also default? Now, under certainty and symmetric information, interest conditions can be calculated with the internal rate of return. Very simple, and you should know this from the introductory class in finance. If we have certainty, if we don't have any risk, and information is symmetrically distributed, then any investment project should simply pay the internal rate of return, and we're done. Under uncertainty and symmetric information, now we need to know the individual risk tolerance. For example, if you're risk neutral, if you're risk averse, if you're risk friendly. And then this needs to be incorporated together with the internal rate of return, or let's say the risk-free rate, to formulate a financial contract. And if we also have asymmetric information, this requires special measures such as an incentive-compatible financial contract or monitoring, because we do not need, we cannot verify the project's returns. And this is yet another third situation we might encounter. So in the first scenario, this is very simple. Certainty and symmetric information, simply take the risk-free rate, the internal rate of return, and you're done. Under uncertainty and symmetric information, we only have risk. And then we need to take into account uncertainty, and then risk tolerance, risk aversion. That is, if you're risk neutral or risk averse or risk friendly, this needs to be taken into account. And with asymmetric information, we usually need so-called incentive compatible financial contracts. And you'll see what is meant by an incentive compatible contract in just a bit. So this is basically foreplay. This is the foundation. We need to come up with financial contracts. We need to know what incentive compatible means. We'll talk about that in just a bit. And it's basically all about information economics and an information economics explanation of what we're trying to do here, of explaining the existence, the very existence of banks. So let's start first with the neoclassical explanation, very short excursion. We have a risk-averse lender, L, and he or she can increase his or her utility by increasing the number of projects she or he is investing in. So we are diversifying risk. However, it might be too costly to invest in a large number of projects, because with each financial contract, with each investment, we need to take into account the transaction costs. For example, hiring a lawyer to draw up the contract, driving to the lawyer to sign the contract, etc. So we have transaction costs. And financial intermediaries, just FI, banks, they can lower those transaction costs by decreasing the number of transactions, lowering the cost of each transaction through standardization of financial contracts, and profiting from economies. There should be economies of scale. That is, if financial contracts have economics of scale, I think it's economies of scale. I'll check that. And if financial contracts have fixed costs, transaction costs increase less than proportionally to the financing volume. In other words, banks, financial intermediaries, standardize transactions, and by pooling transactions, they can decrease the total number of transactions needed for all those risk-averse lenders to invest in our investment projects. And as a consequence, financial intermediaries can lower transaction costs without reducing diversification. So risk diversification isn't touched. This stays the same. And simply by driving down the number of transactions, financial intermediaries can offer a service, and they should exist. So this could explain the very existence of banks. Next, financial intermediaries also act as service providers. They offer certain services in addition to reducing the transaction costs. And this might be a reason why banks exist, because we also get credit rating, credit assessment, project evaluation, and monitoring, other services like security trading, brokerage, financial trading, etc. And in addition, they offer risky long-term loans and accept risk-free short-term deposits. Very, very simple explanation by simply arguing, okay, banks do more than just offering financial contracts. They also offer additional services. This could be a reason, but this is not a very appealing theoretical and not very economic explanation. So let's immediately turn to the information economics explanation. We have information asymmetries, and simply looking at information asymmetries can help us explain the very existence of banks. So information asymmetries could discourage our two parties, the depositors and the borrowers, from entering a contract. And now financial intermediaries can reduce or eliminate information asymmetries by, first of all, evaluating and monitoring projects or formulating incentive-compatible contracts. Those are the two things that financial intermediaries can do. The first thing is a bank will always monitor its borrowers. If you have taken up a loan from a bank, the bank will monitor your repayments. They will look at what is going on with your account. And if there seems to be any problem with you repaying the loan, they will act and they will monitor your project. So this is the first thing. The second thing is that you will be offered a financial contract that includes incentives that incentivize you, or basically that force you to stick to the contract and repay and do the best you can to repay your loan. This is an incentive-compatible contract. In German, we say anreizkompatibler Vertrag. We have borrowers, those are the entrepreneurs. We have capital providers, L, those are the lenders, and basically this is you as customers of a bank. This is you as a lender or as a depositor. And we have information asymmetries between the entrepreneurs and the lenders about the success of business projects. That is, we, let's assume, what is going on now here? Okay, we have our entrepreneurs. They do want to invest in an investment project, and okay, and we have the lenders here. And the question now is, how can capital move from the lenders to the entrepreneurs? Could it be that we do need to include, why is it not here? A financial intermediary in between, so that the lenders give the capital first to the financial intermediary and only then to the entrepreneurs. Why could there be a problem? Because you as a depositor, you as a lender, you do not know anything about the investment project of the entrepreneur. Entrepreneur could be Wirecard, and the Wirecard company tells you, we are the best, we are a tremendous investment opportunity, please give us your money. You as a lender, you do not know anything about the entrepreneur, and it could be that you're only trusting the financial intermediary, and the financial intermediary then decides, okay, let's put a small amount of capital into this company. And this is how it could be that first of all, we need a financial intermediary, and second, the financial intermediary should offer incentive-compatible contracts to both the entrepreneur and the lender, so that this is the at least second best solution with asymmetric information. And the cost of reducing those information asymmetries might be prohibitively high for each individual L, that is the financial intermediaries. They gather information and they provide information to all L, to all lenders for a fee, and that could be one explanation. So the existence of a financial intermediary is beneficial for both parties, the entrepreneur and the lender. First of all, the financial intermediary does what? It takes, let's go back to this page, it takes all the information about the entrepreneurs, it compiles information and sells this information to the lender, and then the lender knows into which company it should invest. In this sense, the financial intermediary could simply be something like a rating agency that gathers information and provides information to all lenders for a fee. In this case, the financial intermediary can amortize the costs of acquiring the information by selling the information repetitively. Each lender reduces his or her monitoring costs by buying the information at a cheaper price, because it no longer has to do it himself or herself. And the entrepreneur is able to acquire the necessary funds for his project, because otherwise the lenders would not be willing to pay into this investment projects. Okay. However, the information provision of the financial intermediary does not eliminate the asymmetric information problems, because in this case, both the entrepreneur and the financial intermediary have more information than L. Think about it this way. The lender doesn't know anything about the entrepreneur. Okay, so the financial intermediary gathers information about the entrepreneur and sells this to the lender for a fee. Problem is now that, can I choose a different color? Yes. It could now be that the entrepreneur and the financial intermediary, they collude, and basically you now have information asymmetry between the lender on the one side and the financial intermediary and the entrepreneur on the other side. So the lender isn't sure if he or she can trust the entrepreneur and the financial intermediary, or whether the financial intermediary simply sells shady information. Because the financial intermediary still knows more than the lender, and the financial intermediary, the bank, could simply make the information about E, the entrepreneur, up. So the problem isn't really solved, it's simply shifted from the relation between entrepreneur and lender to lender and financial intermediary. This is now where, okay, you cannot see anything now. So the information asymmetry now exists between the lender and the financial intermediary. So the financial intermediary would be better off by saving the monitoring costs and selling fictional information, fake news, or cooperating with E. The bank could actually provide false information and share the returns of the project. So the lender, you as a depositor, now you cannot trust both. You cannot trust the entrepreneur and you cannot trust the information by the financial intermediary, because still this is a theoretical model. We haven't talked about reputational costs. We haven't talked about any incentive compatible contract. We haven't talked about litigation. In this very simple theoretical setting where we don't have any legal obligations, where we don't have litigation, where we don't have reputational costs, the financial intermediary could simply make up the information, sell it to the lender L, and you couldn't do anything about this. So the monitoring activity is not sufficient to explain the very existence of a bank, because still the problems arise between the lender and the financial intermediary now. We still have asymmetric information. So how can you alleviate these information asymmetries now between the financial intermediary and the depositor, the investor? Okay, this is where we start with the diamond model. This is a famous model by Douglas Diamond from the University of Chicago. Actually, every year one would think that Douglas Diamond will get the Nobel Prize. Again, he didn't receive it, but this is a sure bet. This is probably the most famous and one of the earliest models in banking theory. And it tries to explain the existence of a bank or a financial intermediary by looking at incentive-compatible contracts that alleviate the information asymmetry between entrepreneur, lender, and financial intermediary. So what is the setting? We have an entrepreneur E who has an investment project with uncertain outcome. Because this is an outcome that is uncertain, that is risky, we mark it with a Y, tilt, and we have an investment volume of 1 monetary unit. The entrepreneur has no liquid funds and thus needs to raise capital from multiple lenders. So we have many lenders, L, and the assumption or the problem is that only the entrepreneur can observe the outcome of the investment projects. Only I, as the entrepreneur, know whether my sneakers, whether my pizza place, whether my startup company will do good or do well, or if it will do badly. So only the entrepreneur knows about the outcome of the investment project without cost. So this is ex post information asymmetry. Without monitoring, E, the entrepreneur, would always report investment outcome Y of 0 to maximize his income. I would always say as an entrepreneur, I'm bankrupt. I don't have any money. Go get it yourself from someone else. I don't have money. But the lender, you as a depositor, as an investor, you would anticipate that. Thus, you wouldn't buy any stocks of this company. You wouldn't invest. You wouldn't provide any funding. Why? Because you know that I'm a crook. So the solution could be, first of all, you have a contract that includes non-monetary punishment that incentivizes E to report the true investment outcome. You make sure that in the contract for your investment, you can punish me as an entrepreneur, me as the company you're investing in, that if I don't repay my loan, you can punish me. And we're talking about non-monetary punishment that could be reputational loss. You could send me to prison. That would be one way. And the second solution is project monitoring by the lender. Yeah, that you are able to monitor the financial success of my startup company, and that you can see how much money I'm making, so that if I report an income or an outcome, in this case, investment outcome of 0, that you do know, because of monitoring, this isn't true. Your income was higher, so please repay your loan. Let's start. Again, this is still without financial intermediaries. Let's start with non-monetary punishment. For example, imprisonment, poor reputation, loss of manpower in case of insolvency. So we have non-monetary punishments, and these punishments without transfer of assets, that is, they hurt E ex post, that they don't benefit L. You're not getting more money simply because you can send me as the entrepreneur, you can send the entrepreneur into prison, to prison. And this gives E ex ante, before reporting the outcome, an incentive to meet the repayment terms punctually and truthfully. Again, why are non-monetary punishment part of this model? Because if E does not meet the repayment terms, he does not have any assets which could be liquidated by L. So it needs to be non-monetary, otherwise this wouldn't work. By the way, on a side note, this is of course very similar to bankruptcy legal procedures, and in case you're defrauding investors, you as a company manager, in most legal systems you can be sent to prison. And obviously if you are the manager of a company that goes bankrupt, hopefully you will not be hired by anyone else, so you have poor reputation. Now in this model, the non-monetary penalty for E, for the entrepreneur, depends only on the repayment amount. Again, Y is your income, and Z of Y is what the entrepreneur pays back on its loan. It doesn't have to be the same. For example, if you have a loan of, say, let's make it this way, if you have a loan of 100 and you have an income of 5,000, then obviously Z of Y should be 100, because you do have, let's go back here, the Z of 5,000 should be 100, because that is your loan. You don't need to pay more. You do not need to pay back more than your original loan was. Very clear. Now, we can only observe the repayment. We cannot observe, at least not the lender, we cannot observe the 5,000. This is unknown to us. We can only see what the company pays back on its loan. So Z of Y is the only observable variable for both the entrepreneur and the lender. The entrepreneur obviously knows the 5,000, but this variable is the only one that is known to both the entrepreneur and the lender. Then the penalty function, that is the non-monetary penalty for the entrepreneur, needs to be based on this observable variable that is observable by both E and L. Then how does the optimal penalty function look like? Well, it should provide incentives for the entrepreneur to meet the agreed terms of repayment. So the optimal contract is a contract that includes a clause with this penalty function, phi star, because it's optimal, depending on the repayment Z of Y, which is the maximum of 0 and H minus Z of Y. And H is the agreed repayment. If it is, for example, this is H, and if you are repaying 100 and you're supposed to pay back 100, well, then the penalty is 0. You've repaid your loan. You do not need to face any non-monetary penalty. However, if your repayment should be 100 and you're only paying back 50, then obviously the maximum of 50 and 0, so 50, this is the penalty you are facing. So H is the agreed repayment. It is the smallest amount E has to pay to L to not receive any non-monetary punishment. And this contract is what we call a normal debt contract. So you need to pay back your loan, you need to pay back your debt, and it includes some clauses or one clause that you have non-monetary punishments and a non-monetary penalty, and this one is actually optimal, and this should incentivize. Why should it incentivize the borrower to pay back the loan exactly as was agreed upon? Any idea? You can write this in the chat window. Any idea? No one's writing anything in the chat window. Well, it's quite clear because it's optimal, because the borrower doesn't get a higher penalty. He or she doesn't get any penalty if he or she repays the loan. That's the first thing. Second, for every dollar or every euro in the loan that you are not repaying, you are getting the same amount as a non-monetary punishment. So that means that, for example, let's say for every €1,000,000 you're not repaying on your loan, you're going to prison for 1 year. If you don't pay back 2 million, you will go to prison for 2 years, and so on. So there's a proportionality for the non-monetary punishment that is proportional, and the penalty is proportional to the amount of cash, the amount of the loan you're not repaying. That is this optimal debt contract. Okay. Now, H again is the repayment. It is the smallest amount E has to pay to L not to receive any non-monetary punishment. Why? Because of the max argument of the function, the punishment will always depend on the greater value. So it's either 0 or H minus Z. Phi star is also incentive compatible because E has no incentive to settle for less than H, but phi star is also minimal in the sense that it is always, the non-monetary punishment is always exactly as high as the difference between the agreed payment and the actual payment. So the borrower is punished, but the lender doesn't get any benefit from the lender not paying back €1 or €2 or €3 on its loan. So this is why this is an optimal contract. It's minimal and it's incentive compatible, so it forces all contract partners to stick to, for example, in this case, the repayment of the loan. Okay. Now, what is the amount of repayment? The entrepreneur offers a repayment which makes L choose the investment project over the risk-free investment, and to maximize his or her own earnings, the repayment will make L indifferent between choosing between both alternatives. So what is the expected repayment? It is the expected value of ZY, and in this case, this is what we call R, the return on this investment. And Z of Y is the minimum of H and Y. So the aggregate repayment to all lenders is, well, it's either the amount needed or what we are repaying, H. So if project earnings are Y less than H, the entrepreneur has to give everything to the lender. And if the project earnings exceed the agreed repayment, we only have to repay the loan. So this, as is always the case, if you have a loan of €1,000,000, you have to pay maximum, as a maximum, you have to repay the €1,000,000. If you have less money, then you can only repay what you have. So it's minimum of H and Y. Thus, what follows is now, we take the probability that we have less cash on hand than the amount of loan we've taken out, times the expected return, the expected income, given the fact that we have less than we've borrowed, plus the probability that we have more income than we've borrowed, times what we have borrowed. Obviously, in case we have more cash as an entrepreneur, we only have to pay back H, and this is the return under risk, and this has to equal the expected value of the expected repayment, actually. So the expected value of Z includes the partial repayment with probability P, Y less than H, and the conditional expectation of Y in case we have less cash, and full repayment H with probability P of Y being larger or equal than H. And H minus R, that is the risk-free rate R, and H minus R, this is the risk premium. So in case of poor project earnings, the entrepreneur is punished without any benefits for the lenders. And because all lenders are risk neutral, they only consider the expected value of the project earnings and not the probability distribution. And independent of the probability of the investment success, the expected repayment is always rate R. Okay. So what are the first and second best solution? Under symmetric information, we have the first best solution, that is the expected value of Y being equal to R, and the entrepreneur's profit is simply the expected return on the investment project minus what we have to pay on our loan. The second best solution, due to the ex post information asymmetry, is an optimal debt contract with a penalty function phi star and a suitably chosen H. And in this case, the entrepreneur's profit is not just the expected return or the expected income from the investment project, E of Y minus R, but it is H, because we do not only have to pay back the loan, it could also be that we face a non-monetary punishment, which is captured in H. And the cost of asymmetry, this is now the difference between the first best and the second best solution. So if we write, we can do this actually, if we have E of Y minus R minus E of Y minus H, small h, this is H minus capital R. And this is the cost of asymmetry. Those are the agency costs here, because in case we have information asymmetry, the entrepreneur doesn't arrive at expected value of the income Y minus R, but he or she only arrives at expected income minus H. So these are the agency costs. Now note, what is now the advantage of project monitoring? The penalties always reduce welfare. Obviously, because we have information asymmetries, this is not the best solution. We would always be better off if we could only reduce or eliminate the information asymmetries. The optimal debt contract is a solution that helps us live with information asymmetries. They still exist. The contract only forces all participants to stick to the contract. Therefore, it could be advantageous for E to allow all lenders to observe the project earnings. So what happens is the information asymmetries are eliminated. The entrepreneur must pay the monitoring cost C to every lender. And if we have M lenders, we get the costs of monitoring of being M times C. So the entrepreneur needs to provide information, and he or she needs to provide information to each and every lender. So we M times C monitoring costs. And the first conclusion in the diamond model without financial intermediaries is that the choice of the contract type depends on the respective contract costs. So we have welfare decreasing penalty costs, H minus R, or we could also do the opposite. We can take monitoring, and if monitoring costs are smaller or larger than the welfare decreasing penalty cost H minus R, the agency costs, it could be that the entrepreneur chooses monitoring, eliminates information asymmetries altogether, or he or she chooses the optimal debt contract, in which case we have a welfare decreasing penalty cost of H minus R. This is the situation without financial intermediaries. And now it should be clear how financial intermediaries and how banks come into play, very simply because they can offer something, they can offer a contract that reduces overall agency costs, because they can do something better so that the agency costs in comparison to the monitoring costs and the penalty costs in this situation without financial intermediaries, the overall cost with banks are actually lower. And this is what happens now in section 2.3. Now we have the diamond model with financial intermediaries. And the problem is, again, we have risky projects. A high requirement of lenders result in high costs in both the cases presented above. And the solution could be monitoring costs could be reduced by delegating the monitoring to a single third party, the financial intermediary. And the financial intermediary can be beneficial for both the entrepreneur and the lender if the financial intermediary decreases the costs associated with the cooperation problem. And the benchmark is now the direct entrepreneur-lender relationship. However, we've seen that the delegation to the financial intermediary simply shifts the cooperation problem from entrepreneur-lender to financial intermediary-lender, because we cannot trust the financial intermediary now. So what can we do now? This is the diamond model with delegated monitoring. And this is actually very famous. Delegated, if you ever hear delegated monitoring, you have to think about the diamond model that is presented here. This is a reminder from the Hartmann Wendels Pfingsten Weber textbook that we have the entrepreneurs, the Unternehmer in Deutsch, in German. We have the financiers, we have the lenders, and we now have a financial intermediary in between. And this seems to reduce overall agency costs. Now what happens? The financial intermediary takes over monitoring. Again, we used to have M times C monitoring costs for the entrepreneur. And these M times C monitoring costs, they are now reduced to 1 times C, because the financial intermediary only does this one time and then provides the information to the lenders. The problem then is that information asymmetry now exists between the bank and the lenders, and the delegation costs, those are the necessary costs to solve the cooperation problem between the bank and the lender. And to justify the usefulness of a bank and to justify the existence of a financial intermediary, one then has to show that despite the additional delegation costs, the total costs of the agency costs decreases. And the model assumption is now, first of all, that the financial intermediary is risk neutral. The bank does not own capital, and the procedure is that the financial intermediary receives payments from all lenders. It finances the project of the entrepreneur. It gets repayment from the entrepreneur and transfers cash back to the lenders for their investments. Now, the total costs of a financial intermediary is the monitoring costs. We only have it this one time because we only have one entrepreneur which we need to monitor. But we also have the delegation costs, and we call this D. The financial intermediary creates information symmetry. That is, we have a direct investment by the lenders into the entrepreneur's project is now replaced by investing into the bank, or we call this the project financial intermediary. We have the same success probabilities and the same share of earnings, and we reduce the delegation costs by diversification. So the financial intermediary finances projects of several entrepreneurs. It invests funds from M times N lenders in N projects, and every lender agrees on a debt contract with a penalty function with the financial intermediary. So the lender now has a debt contract with a penalty function, and the total amount of repayments depends on the outcome earnings of all projects with the entrepreneurs. And through diversification, the probability of a negative outcome of the whole project is then lower than the project earnings because the project earnings are independent. That's it. The repayment amount, H, the lenders are willing to accept, and the welfare loss decreases. And this is the result of the diamond model after diversification. So after the D, the delegation costs we've defined here, after delegation costs become negligible, the existence of a financial intermediary is justified if and only if the monitoring costs, which now adds up, if the monitoring cost is lower than the expected value of the penalty function, which should hold in most cases. That is what? If we have such prohibitively high monitoring costs, even for one entrepreneur, that we would be better off with an optimal debt contract with a penalty function, then everyone should simply invest directly in the company and the entrepreneur and do an incentive compatible optimal debt contract. However, if one monitoring cost C, and the bank only has to do this once, if the monitoring cost is lower, is smaller than the welfare loss that is due to the penalty function in the optimal debt contract, then obviously the financial intermediary is beneficial. And then we should do this, and diversification helps to reduce the additional delegation costs to zero. So we only need to look at the monitoring costs once. And it's quite clear that the monitoring cost C with a financial intermediary is always better than the situation we had here, where we said, okay, the investor, the lender himself or herself can do this M times. This doesn't make any sense. Then every lender has to do this again and again and again. And then obviously a financial intermediary makes sense. Okay. So this is the diamond model and the optimal debt contract and the explanation for the existence of banks. It helps reduce information asymmetry. It helps to alleviate the agency costs that are associated with the information asymmetries that exist between investors and entrepreneurs, investors and the bank and the entrepreneurs. So let's now move to some more practical functions of banks. Now, we've already talked about the general functions of a bank, of a financial market. Financial market in general performs several tasks, that is coordination, allocation, and selection. Now, coordination means what? It means that financial markets help to match lenders with borrowers, and they provide them with an opportunity to trade financial contracts. Allocation means that financial markets allow for the efficient allocation of capital, of funds. And selection means that financial markets also help to select the market participants that should be allowed on a financial market and those who should not be allowed to interact with other agents on a financial market. This could be done by certain regulations, could be done on the basis of certain criteria like credit risk, qualification, trading qualifications, etc. So this is selection. In addition, we also have more general functions that especially banks fulfill. First of all is lot size transformation. Banks match investments of different sizes. Usually we have small investments by depositors, but also large loans, business loans, firm loans, mortgage loans on the other side. And these transactions, these contracts need to be transformed when it comes to lot sizes. Then second, we have maturity transformation, meaning that usually depositors want to invest short-term and borrowers need long-term loans. And because those maturities do not match, banks can transform maturities. That is, they take in a lot of short-term deposits and they transform them into long-term business, firm or mortgage loans. This also means that usually the funding structure, the financing structure of a bank is very fragile. What is fragile? Well, obviously financing is short-term, investment is long-term, and this is actually quite problematic. If you take a look at the balance sheet of a bank, this means that we do have short-term deposits and usually long-term loans on the asset side. And because financing is short-term, this means that the financing structure, the funding structure is fragile. Meaning what? At any given time, depositors could reclaim their deposits, and then the bank would be without financing and it could go bankrupt. And this is one of the very easiest way to understand why banks are regulated and why they are supervised, because of their because of the fragile funding structure that is due to maturity transformation on its balance sheet. Yeah? It's very simple. And last but not least, we can also see that investors and lenders and borrowers have different risk aversion, and they seek different investments when it comes to risk. So they want different financial contracts with different risk. And this is also something banks can transform. They can transform the risk investors are willing to take and borrowers are offering to the bank. So we have risk transformation. Next, we also have, rather than abstract services for their customers, we have very important functions for the economy as a whole. We have the supply and creation of money, because banks do not only match borrowers with lenders in a zero-sum game, but they are also able to create what we call commercial bank money within the banking sector, and therefore they create additional credit, they create additional liquidity, and commercial bank money is created by placing central bank money into deposit accounts or by commercial banks making loans. You learn this in economics and in financial intermediation in more detail, but there are some very simple models that are also controversial, I have to say, which argue that banks can actually increase the amount of capital and the amount of money that circulate in an economy. And last but not least, they also provide liquidity by investment services, and they facilitate money transfer and cash transfers. Zahlungsdienstleistungen in German. This is very important, and especially nowadays with fintech companies growing more and more with their business, it could mean that banks lose some of their original functions, but it could also be that new players and tech companies need to be regulated and need to be supervised by financial supervisors, because they are offering very crucial services to the economy and to all households. Now, yet another way to systemize banking functions is to distinguish between elementary functions and transforming functions. We've seen elementary functions: conversion, deposition, transport, financing of cash and capital, and the transforming functions would be lot size, maturity, and risk transformation. Okay. Then let's make it even more practical. In the end, what are the business operations of a bank? First of all, they engage in deposit business. That is, they accept external deposits as investments. That's their main source of financing usually. We have credit business or loan business. You grant loans, and those are the investments of a bank. Discount business, purchasing bills of exchange, not so much important nowadays, and trading business, and of course investment banking. Now, we also have safe custody, investment business, loan acquisition business, guarantee business, gyro business, cashless payments, etc. We've already seen this in the enumeration of paragraph 1 of the German Banking Act. Yeah, paragraph 1 des KWG. This is where all the different financial services that qualify a bank in Germany as a credit institution, those services are all listed in paragraph 1 KWG in the German Banking Act. Okay. We've already seen that you can basically distinguish two main types of banks: commercial banking and investment banking. I've talked about this already. Commercial banking is usually just deposit and credit, loan business, everything else also with payment transactions, but it's not trading, it's not related to capital markets. This is then summarized in investment banking. So all the services related to securities, anything that is related to capital markets, and then banks act as financial intermediaries, and they support trading, they support investment activities, and they supply or they support their customers when it comes to financing large deals and investments. What else can we talk about with financial services? The The financial services a bank usually offers are investment brokering, investment advice, brokering should be, broking is not correct, investment advice, operation of a multilateral trading platform, placing financial instruments without a firm commitment basis, contract brokering, purchase and sale of financial instruments, portfolio management, proprietary trading, foreign currency dealing, factoring, financial leasing, asset management, etc. Not very interesting. Maybe to be more precise, what we mean with deposits. Banks obviously accept deposits, and the placement of deposits by micro investors, this plays an important role for the economy of a country, because deposits are basically the main part of a country's money supply. They are very important for regulation. Actually, they are one of the reasons why banks are supervised in the first place. And if we see an increase in deposits, this leads to an increase in the amount of money circulating in the economy, because all other factors equal, money supply that is also increased by banks will rise. This is why banks will increase money supply if they are provided with deposits that they can give out in a higher amount in terms of loans. This is the so-called credit multiplier, very simple model how banks can create money. It is based on the simple assumption that modern banks only have to retain a portion of the capital they receive from depositors. This portion is held back as a reserve so that the bank remains liquid in the event of cash withdrawals, but the remaining part will be given out as loans. And this is a very simple model. So we only have one bank in our system. The required reserve rate is 10% of the total deposits. And to illustrate this, now, what are the required reserves? We have an initial period, A, we get 50 deposits. We have to reserve 10%. So reserves are 5. We can give out 45 euros, dollars or pounds as loans. And then in the intermediate period, we increase deposits. Now it's actually in pounds sterling. We increase this by 50,000 pounds. This is actually 50 million. So we have deposits of 50 million 0.05. We see that if the 50,000 go to the reserves, we have actually a reserve rate of 10.1%. And then again, we can take the 50,000, keep 10%. So we have 5.005 in reserves, and we can give out 90% of those 50,000 in increased deposits as a loan. So again, reserve ratio is 10%. Okay, now period 0, we have deposits with a value of 50. Actually, this is euros. The example on the table is pounds. It doesn't matter. Required reserve rate is 10%. For every 10 euros that the bank receives, it retains 1 euro in cash and can grant 9 euros as loans, 5 million as reserve, 45 million for lending. A bank does not make any profit just by depositing cash, so the bank should stay with the required reserve of 10%. It reduces the reserve ratio and gives out 90% again as loans. Now in period 2, the bank returns to a required ratio of 10%. We give out the additional loans of 45,000 euros, and the credit multiplier is defined as the relation between the changes in deposits and the changes in reserves. And in this case, it's 10. And you can see the credit multiplier is always the reciprocal of the required reserve rate. And if the reserve ratio is 10%, then of course the credit multiplier is 10. Now we extend this. There is more than one bank. If Bank A experiences an increase of deposits by 50,000 euros and retains 10% as reserve, the remaining 40,000 euros can be granted as loans, and they will eventually return to the bank. So the money is lent to an individual who reinvests it at Bank B. So the money goes out to a loan to a person, and then he or she gives it back, at least in part, to the bank as deposits. So the bank again retains 10% in cash, which now is 4,500 euros, and invests the rest for example, into lending. And then this goes back to bank C and bank D and so on. And you can see as soon as you have more than one bank and some of the loans get back to actually a cash account with another bank, you get a credit multiplier. So every step leads to a growth of 90% compared to the original 50 million or 50 million and 50,000 euros. So the sum of the additional deposits created with n banks therefore equals 50 plus 50 times 90 plus 50 times 90 squared and so on. And this geometric series converges for n to infinity to 50 divided by 10%. So this is 500. So taking this very simple model, if you take this simple model and if you follow this simple rule that you do have an infinite number of banks, at some point you can see that the deposit or credit multiplier is equal to the reciprocal of the required reserve, and the grant of 50,000 euros into the system leads to additional 500,000 euros in deposits. So this is how, because you have a reserve rate and banks can give out more loans than they have to keep on their balance sheet, you can create more capital within the system if you have more than one bank. So that's the credit multiplier. Disadvantages of the model: assumptions of the simple model are not very realistic. System has weaknesses, for example, that money can go overseas and the individuals invest their capital in government bonds or keep it as cash rather than depositing it. You do not take out a loan with a bank to give it and to deposit it in your savings account with another bank. That's quite clear. Nevertheless, the bank creates money. Obviously not in the vicinity of the 500 here, but money supply will increase. And this monetary function of bank deposits is also often considered as the main reason for more regulation or regulation in the first place and stricter supervision of banks in comparison to institutions without deposits, for example, insurance or investment companies. Insurance companies are regulated and supervised for completely different reasons, but this is one of the reasons why banks are regulated. Okay. So financial services, we have deposit-taking institutions, we have no non-deposit-taking institutions like insurance companies, pension funds, investment funds, unit trusts, leasing companies. Not too much new information here. We've already seen this in the first lecture, I guess. We can see that credit institutions are not only distinguishable from other financial institutions because of deposits, but deposits can be withdrawn arbitrarily at any point in time. And this is quite different to, say, for example, insurance companies. So investments at other financial institutions require a contract with a regulated amount of frequency, but the amount of frequency of the deposit can be determined freely by the lender. So in that case, you, the depositor, if you have a savings account. So with a pension fund or insurance premium, this is usually done on a monthly basis, and liquidity risk is not so much a problem for say, an insurance company. But with a bank, it's quite important. Now, in the European Union, banks are allowed to offer a full range of services. In the UK, we have the so-called Financial Services and Market Act of 2000. It also allows banks to offer various services, but it slightly differs, and it definitely will differ now that Brexit has been done. So according to the UK's Financial Services and Market Act, 2000 banks in Great Britain are allowed to operate in taking deposits, issuing electronic money, implementing insurance contracts as a client, investment management, and instruction and advice on investments. Just to give you an idea. Now, during the last years, an increasing amount of conglomerates have been formed in the financial markets. And this growth is mainly driven by technology, the globalization of markets, the deregulation of geographical and product-specific restrictions, but also by the high amount of regulation after the financial crisis. This started in the European Union, most notably with the second bank directive of 1989, which allowed banks to work as universal banks banks, and also from time to time then reduced geographical restrictions. And nowadays we do have Spanish, Italian, we have British banks, Swedish banks operating, of course American banks also, banks operating in Germany and vice versa. But we used to have many geographical restrictions where we prevented banks from other countries to operate in Germany. And later on, I will give you very interesting examples of how even American banks in the US were required and were prohibited sometimes, if they were, for example, located in one state, to operate branches in another state. So they had very strict interstate and intrastate branching restrictions. Okay. Now, banking services. I think I have talked enough about the different services banks offer, and you should be aware of most of these services. So we have payment services, we have deposits and loans. You should know how this works. Investment, old age provisions, insurance products, online banking. This should be very clear, and I think I'll skip these. Online banking is a huge trend, has been for almost 15-20 years. The interesting thing here is that online banking, I would say a couple of years ago, for some time was very boring, because most banks offered online banking and they thought, okay, this is just similar to a call center. You have to have it, but you cannot do anything more than just a regular online banking. And this is where fintech companies, financial technology companies, entered the market, and they are trying, some have succeeded, but most of them are still trying to compete with traditional banks when it comes to digitalization and digitalization in the business processes of banks. So we have new business-to-business relationships, value chains are restructured. We can see that online banking has become more and more important. Branches are being reduced, because branches, if you almost exclusively engage with your customers based on online banking, you do need less branches, because branches only produce costs. And so you're cutting down the number of bank branches, you're focusing more on online banking and financial technology, and this will be a huge trend in the next years. And I think most of the things I have on the slides when it comes to online banking, we can skip this. It is clear that online banking will not vanish. You can also engage in forex trading platforms, in multi-bank platforms, etc., with some advantages and disadvantages. I had a small discussion here. Obviously, online banking wasn't very profitable the last couple of years, because it was simply something done by traditional banks in addition to branch systems. However, now I would say that many financial technology companies, many fintech startups, they've seen the opportunity, and they're grasping for the opportunity to make online banking and the use of financial technology quite profitable. And this is something we'll see a lot in the future. Okay. So this was a short introduction to financial intermediation theory. You've seen the diamond model. Every now and then in the exam, you will be asked to give the main ingredients and to explain the diamond model, how it works, what the assumptions are, and how it works in information symmetry, with information asymmetry, with and without financial intermediaries. And please make sure that you do know about this diamond model and can name some of the services and functions banks can offer. Okay. Do you have any questions? If so, you can write your questions in the chat window. What is your opinion about more supervision and regulation of financial intermediaries? That's a tricky one. I do think more regulation and supervision is needed. The problem is that we've now arrived at an amount of and an extent of financial supervision that many banks consider regulation to be prohibitive when it comes to offering certain services or offering certain products. So you can see that very simple products that are marketed to customers and retail customers, they require such a paper trail that some banks have ceased to offer these services because they do think that regulation is so stiff and so tough, it's no longer worth the effort, and banks have stopped offering these products altogether. And this shouldn't be the result of financial supervision and regulation, that if you do want to force banks to stop offering certain services, then you need to prohibit these services. This was done, for example, for certain contract for differences, CFD contracts with the German BaFin. They prohibited certain financial contracts, financial instruments being marketed to retail customers. But if you want to do so directly, and do not force banks out of the market by installing supervision that is so tough and so prohibitively tough that banks simply leave the market. No? Okay. But we'll be talking a lot about financial regulation in chapter 7. So we'll come back to that question later on. Any other questions? No one's writing in the chat room, in the chat window, so I guess there are no further questions that should be on the recorded video. So thank you very much for your attention and have a nice evening. Thank you very much.